Well, this is the first time that we've seen a real buyer's market since the Great Recession. Sellers are kind of slow to catch up and a little bit in denial about reality. That's more true in markets that had really big price increases during the pandemic and have since come down because sellers are anchoring to how high prices were during the pandemic. It doesn't feel like to them that it's that great of a market because of how high mortgage rates are. In December, we were forecasting that mortgage rates would.
We're going to get an outlook for the housing market and mortgage rates with our next guest, Daryl Fairweather, Chief Economist at Redfin. This video is sponsored by Kalshi. It's a fully regulated platform that lets you trade on real-world events from economic data to political outcomes. Sign up and use my code LIN, L-I-N, in the description down below or scan the QR code here. And new traders will get $10 deposited to your account when you trade $10. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas and over 140 countries. More on that later. Daryl, welcome to the show. Good to see you.
Hi, thanks for having me.
I think the first question that a lot of people have on their minds is, after the nomination of Kevin Warsh, what will mortgage rates and interest rates look like following the appointment of a new Fed chair?
I'm anticipating and partially hoping that this means that mortgage rates will be more stable this year than they were last year. Anytime last year when there was a controversy regarding the Federal Reserve and the president expressed his frustration, it would add volatility to mortgage rates. Just the uncertainty of not knowing exactly how monetary policy was going to go in the future added a lot of volatility to current rates. And Warsh is a pick that I think Wall Street will embrace. He is a Wall Street insider. He is a former Fed governor. He's a pretty traditional pick. And I think that will contribute to just more stability in rates moving forward and less of this swing and volatility that we had last year.
If you take a look at the 30-year fixed rate in the U.S., this is from the St. Louis Fed, you can see that they've already been coming down from their peak a little bit. So a few questions regarding this. First, what is the relationship, if any, between the 30-year fixed and the Fed funds rate?
Well, the Fed funds rate controls short-term rates, the daily overnight rate. But mortgage rates, I mean, they're based on 30-year mortgages. Oftentimes, those mortgages are paid down early, but those mortgages typically last for 10 or more years. So it's much more about future expectations. So when there's a lot of pressure on the Fed to lower rates, if that is not justified by economic indicators, Wall Street takes that as a signal that, okay, they're lowering rates now, but they may have to increase rates even more in the future, or inflation maybe even higher in the future. So the Fed partially can control what mortgage rates do, but really it's more about expectations, and they don't have a lot of control about how the markets perceive those expectations. It does have more to do with the broader economy and those economic signals.
And so the reason I ask that is because some economists have predicted that Warsh may be a little more hawkish than some people may have anticipated for other candidates. And if we have a situation where the Fed wants to keep the Fed funds rate higher for longer, even if the Trump administration wants the other way, will we get a situation where the mortgage rate stops coming down, which has been the trend since basically 2023?
Yeah, I don't think that there is a lot of certainty over how that would affect mortgage rates because, I mean, right now, the Fed funds rate, it's considered something on like the restrictive side of neutral. It's probably in the neutral range, meaning that it isn't speeding up or slowing down the economy, but maybe a little bit closer to restrictive than to truly neutral. So if we kept interest rates restrictive for longer, it might mean that later on the economy will slow down and we'll have to lower rates even more. And so that long-term rate expectation might not be all that changed, even if Warsh is more of a hawk. And he's also only one person on the open market committee. So there are other people who are voting. So even if he is hawkish, we still have other Fed members who may be more dovish. So I don't think it's going to matter all that much. I think what matters more is that hopefully we'll have somebody who can communicate well, who can explain why the Fed is doing what they are doing. And that alone, I think, will be good for rates, that, there's at least a captain in charge that is communicating well.
So what is Redfin's view on the mortgage market this year? So specifically on rates, the 30-year is currently at 6.1. This is from Kalshi, a prediction market. Traders are predicting a 71% chance that rates will stay above 6.2% this year. What is your view?
Yeah, that's pretty close to our view. I mean, even back in December, we were forecasting that mortgage rates would average 6.3% for the year for the 30-year fixed rate. I mean, basically, like there's no reason to think that mortgage rates will come down. I mean, they'll probably come down in the long run, but this year we still have high inflation. We have a bit of a wobbly labor market, but I think that rates will probably stay pretty stable. There'll be swings. So I think how big those swings are can matter quite a lot, but the average will probably be around 6.3%.
What would need to happen for rates to come down? In other words, the tail end of the probability curve here.
I mean, we need inflation to come down because that would be a real justification for the Fed to start lowering interest rates. And to get inflation down, it has more to do with what's going on in the broader economy. It has more to do with policy. It has to do a lot with expectations as well. So it's not something that the Fed can control directly, but they can keep interest rates high until that happens to help dampen the pressure on higher inflation.
Okay. Well, if your base case is that rates are going to stabilize this year, what's going to happen to affordability and what's going to happen ultimately to buyer and sellers activity this year?
We expect that home prices will go up slower than wages or even the overall pace of inflation. And so in real terms, homes will get more affordable. And rates are already lower than they were last year. So we think this year home buying is going to be more affordable, and we expect that rents will start to go up a bit, and that will push more people into buying a home as well. We're only forecasting a 3% increase in home sales. So we're not talking about big differences, but we are thinking there's going to be a slight improvement in demand.
What are some of the biggest hurdles? Let's talk about home affordability now. What are some of the biggest hurdles towards a more affordable housing market for the average American? I guess this year and beyond, just generally speaking, right now in the economy.
Well, prices remain quite high, even with mortgage rates going up at their fastest pace on record back in 2023. Prices stayed pretty stable because higher rates incentivized homeowners to stay in their homes longer. Basically, everybody who could refinance during the pandemic did. So many mortgage holders have mortgages below 4%, and rates are now above 6%. So if they were to sell and buy again, they would have to pay a hefty premium. And that's why sellers are staying put. That's why supply is restricted. And that's why prices have not come down despite demand coming down. Now in 2025, we're seeing more supply coming online. We're seeing sellers start to drop their prices and buyers get discounts, prices below the listed price. So I think moving forward, we should see prices. They won't go up faster than inflation. They'll probably stay stable or maybe go up just slightly under inflation. So in real terms, buyers will be getting better deals.
Okay. Earlier in January, Trump made the following statements at Davos at the WEF. He said, "You have these big companies, these big corporations buying up thousands of homes and renting them or doing whatever they want, or doing whatever they do with them." So he signed an executive order Tuesday directing federal agencies to curb institutional investor activity in the single-family housing market. And once again, the prediction markets are saying that there's a 40% chance, 39% chance that there's going to be new legislation restricting institutional single-family home investment this year. Will that make a difference, Daryl?
No, I don't think it will make a difference. Institutional investors represent a pretty small share of all home buying activity. I've seen estimates of like 3% or less. And if you banned institutional large investors from buying single family homes, they would probably just be replaced by smaller investors. Like if you said that, you can't own more than 100 homes and still buy single family homes, and you'd see a lot of corporations buying just 99 homes. And the types of homes that they're targeting are the types of homes that are good investment opportunities. Perhaps they're fixer-uppers or they're in up-and-coming neighborhoods. They're the kinds of homes that investors like. So just because you ban institutional investors doesn't mean that all of a sudden first-time home buyers are going to have an easier time buying homes. And also the fact that it's only about banning them from single family homes, I think tells you a lot. Like, we need to be thinking more about all types of housing, multifamily housing, and nobody has a problem with investors owning condos or apartment buildings. So It's hard to get to a place where you see why they should be banned from single family homes.
What do you think is going to happen on the supply front this year? I know that's pretty broad. We're talking about different jurisdictions across the U.S. and different types of homes, but which types of homes and I guess which areas do you and Redfin think will get the most supply boost this year?
Yeah, at a national scale, I think new construction is going to be pretty weak this year. There's a lot of challenges for builders. Interest rates affect them because they have to borrow for these projects. They're facing labor constraints in part due to all of the immigration crackdowns. They're also facing tariffs when it comes to some of their materials. And there's weak demand because mortgages are so expensive. So even though there's been a lot of legislation to make it easier to build and to reform land use, this year probably won't be the year where we see a big boon in construction. The places where there has historically been a lot of construction, Texas and Florida, are some of the weakest housing markets right now in terms of demand. So if we see new construction anywhere, I think we're going to see it in the places where demand is hotter, like in the Midwest and Northeast, and also parts of the West Coast that have been holding up well in terms of value.
Earlier in January, just going back to affordability of mortgage rates, again, the government wants homes to be more affordable, and they're different parties have different ways of doing this. This is what Trump announced in January. I'm instructing my representatives to buy $200 billion in mortgage bonds. This will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable. This comes as mortgage rates dropped sharply following this announcement. This was mid-January, so it's not exactly recent, but can you just comment on this development and whether or not this trend may continue?
Yeah, so this is one way to bring mortgage rates down is to buy mortgage-backed securities. This is something that the Federal Reserve has done during past recessions. They did it at a much larger scale. Yeah. And when this announcement came out, mortgage rates did drop by about 15 basis points, which is significant. But then that drop was erased when the president started commenting on invading Greenland, and there was a Sell America rally there. Yeah. So it's the kind of thing that can be easily kind of lost in all the volatility of rates. So I think it did have a real effect, but I don't think it's going to be big enough to really make a difference when there's so much else going on in the economy and the world.
Well, overall, how would you characterize the sentiment of home buyers now? This is an article that your colleague published just last week. 2026 housing market mood. Buyers are cautious. Sellers are showing up, and agents see signs of busier spring ahead. Pending home sales are declining, and the homes that are selling are taking more than 2 months to find a buyer. Why do you think that's happening?
Well, it's really because sellers are pricing too high. Homes that are priced appropriately, they sell really quickly, or homes that are just desirable. They have all the features that home buyers want. They're move-in ready. Those are still selling with multiple offers in some cases. But it's not like it was during the pandemic where any home, no matter how many problems it has, is getting multiple offers. That's definitely not true anymore. And the markets that were the hottest during the pandemic, like Austin and Boise and Fort Lauderdale, are some of the most quiet markets right now in terms of demand. So it's a big shift, and sellers need to catch up and just start pricing appropriately if they're serious about selling.
Okay, and you're noticing this across the housing market, or is it primarily sellers that are posting their homes at too high of a price, or maybe new developments or new homes being priced too high as well?
Well, builders are some of the first to react and lower their prices because they see it as very transactional. They're just trying to get these homes off their books and move on. Whereas sellers, they have the option to stay in their homes. And that means that they have a higher reservation price because they can just delist and keep living in the home, and they can do it with a really cheap mortgage. So that's why I think sellers are kind of slow to catch up and a little bit in denial about reality. That's more true in markets that had really big price increases during the pandemic and have since come down because sellers are anchoring to how high prices were during the pandemic. In markets that had more of a steady increase, like in the Midwest, sellers are pricing appropriately and demand is still there. So it's not as much of a problem there.
Well, prices have been marching higher for quite some time. If you look at the Case-Shiller price index, it's been going higher and higher for years now. So this trend isn't exactly new. Why is it that it's just in the last couple of months to last year, Daryl, that buying activity has been slowing down?
It really has to do with mortgage rates. I mean, just in the matter of like a couple of months, mortgage rates went up at their fastest pace. And that added like up to thousands of dollars per month to home buyers' expenses when buying a home. And you can see it in terms of the kind of demand. Like people who have cash and are able to navigate around mortgage rates are still buying. But people who have to finance and are like first-time home buyers, maybe they're putting down a low down payment, they're opting to rent instead, because when you compare like renting an apartment to buying a condo, it's obvious that the rental payment is more affordable in the short term.
Well, you mentioned that you expect prices to still rise a little bit, just not at the pace of wages. Well, do you expect any type of housing to correct to the downside?
Yes, and that's already happening. Like condos in Florida, those have come down in price a lot. Part of that has to do with regulations that were passed after the Surfside condo collapse that required condos to shore up their HOA fees and their funds. And we've seen a quick correction there with condo prices coming down considerably. There's also a lot of new condo construction. So for condos in general in Florida, those have come down, and broadly in Texas and Florida, prices have come down too, even for single family homes. Mm-hmm. So yeah, corrections are happening in certain pockets.
I guess that is reflected in this article here. Typical home buyers who scores a discount get 7.9% off. This is an article published last week by Redfin News. Again, is this mostly from the condo market that you're talking about now?
Condo market's more pronounced, but it's happening like broadly. Like these are averages that we're talking about in terms of discounts that buyers are able to get. And this is a discount from the initially listed price. So it just goes to show how sellers were kind of off the mark in terms of what they listed their homes for last year.
Okay. In the past, when you've seen this type of data appear, typically what does that signal, and what follows after these kinds of discounts?
Well, this is the first time that we've seen a real buyer's market since the Great Recession. Wow. And this is different than the Great Recession, though, because obviously there was a recession going on in addition to a foreclosure crisis. And there were many reasons why people weren't buying homes. This time, it really has to do with mortgage rates. And the mortgage rates are what's keeping people out of the housing market. It's keeping them renters. And even though buyers are told, or like they hear that it's a buyer's market, it doesn't feel like to them that it's that great of a market because of how high mortgage rates are. Any
sort of forecast as to how long this gap between the selling price and the actual buying price collapsed? In other words, the discount?
Well, it could be years. It could be like maybe 5 years, maybe longer. I mean, part of it has to do with demographic trends. Yeah. During the pandemic, this was when millennials were at peak home buying age, and millennials are a very large generation. Gen Z is a smaller generation. At the same time, we have baby boomers who are retiring or, they're expiring. So their homes are going to be being put on the market. But a lot of the homes that baby boomers occupy are not necessarily the homes that Gen Z wants. So I think we're going to have a situation where some homes fall in value, they actually come down in price, while some homes are able to retain their value more because they're more desirable to younger generations. And it also depends on like where demographics go moving forward, if we see population increase or not.
Well, let's just talk about the future of demand. So you've posted on your own social media X account that Gen Z is buying homes, but it's a trickle, not a flood. You said Redfin data shows their ownership rate hit 27.1% in 2025, still lagging behind previous generations. So comment on this trend. I guess there's an affordability crisis. Things are getting expensive for everybody, especially the younger generation. Do you expect this trend to last? In other words, do you expect this current generation to persistently lag behind prior generations, or do you expect them to pick up in a few years as they get older and their incomes rise?
Yeah, so Gen Z is doing slightly better than millennials in terms of their homeownership rate, the same age, but still behind Gen X, still behind baby boomers. And I think the Gen Z homeownership rate will continue to improve, but will lag behind where Gen X and baby boomers were at the same age. And that's really because of housing supply. I mean, baby boomers got to buy homes back when we were building lots and lots of homes. And even Gen Xers, they benefited from that housing supply that was created from the 1940s through the 1970s. And we stopped building homes for millennials. We stopped building homes for Gen Z. So the homes that they get may be very old homes that need a lot of renovation, but I think that they will find more opportunities for home ownership, especially as baby boomers start to sell.
Right. And what does this mean for developers? Are they picking up on this trend?
Well, developers, they tend to focus a lot on studio condos, one bedroom condos, because that's where they can make the math pencil. Like if they have a certain plot of land and they're trying to sell as many units as possible, they'll often default to studios and one bedrooms. They built a lot of those during the pandemic, and now there's an excess supply of them. And what really we have a shortage of are homes for families, whether that be single family homes or townhomes or condos that are like 2 and 3 bedrooms. Those types of homes are not being built. So I think that developers have been going with kind of what's been the historical safe bet and aren't really reacting to what buyers really desire right now, but hopefully that will change as we make it easier for builders to build.
Well, ultimately, what do you think needs to happen in the in the U.S. to make homes more affordable to everybody, and especially to the demographics that you've noted are struggling to keep up? You've noted in your research, where Redfin has noted in the research, that Black Gen Zers and Millennials are half as likely to own their homes as white counterparts, for example. So, how do we make homes more affordable to all?
I think we need to take seriously this challenge of building more homes, especially for families, in the places that people want to live and where incomes are high. There is an especially acute shortage of homes in cities like Los Angeles, San Francisco, Boston, DC, New York, all these major job centers where people can earn high incomes that can't afford to have a family there. And in order to accomplish that, we need to reform zoning, which has been happening in states like California and in New York. But I think we also need to subsidize construction, help the construction industry find labor at an affordable wage, and also like streamline the permitting processes. And I know that that is being accomplished like in piecemeal. We're making small improvements, but I think we really need to see this as a very large challenge that will ultimately help the overall economy. Because if people can live close to their jobs, we'll have a more productive economy overall, and that's going to be good for everybody.
Are you in support of caps on rent and rent control overall? Have you noticed, or is there any research or evidence to support that helps with affordability overall?
No, I generally am skeptical of capping rent. I think that, in some instances, it can help a community that is going through a lot of change, that is getting a lot of new development. But I think in general, it just makes the housing supply problem worse. So I think that if we're going to apply rent caps, we should do them very selectively and time constrained. It should not be the default policy for housing, because it just makes the problem worse when you make it more difficult, really, for investors to get a return on building more housing.
And when you mentioned the supply of housing needs to increase, and you talked about zoning, I'm improvements in zoning and changes in legislation around zoning, I'm assuming you mean then that the supply needs to come from the private sector, or do you mean to suggest that the public sector needs to step up in providing public housing as well?
I think that we should be making it easier for the private sector to meet market demand, because right now they're not able to. So that would be, I think, the first priority. But there is a place for public investment too, especially because the housing market is cyclical, that we have these booms in construction followed by busts. I mean, that's what happened. We had a lot of construction during the pandemic. Builders all jumped in at the same time. They got the math wrong on exactly how much they would be able to sell those homes for once they sold. And now we see a decline in construction. These booms and busts always happen. So during those bust times, there is a role for public investment, because the government can, finance projects at better rates than the private sector. So I think that there's a place for both of them.
Well, I want to comment on your book now. This is called Hate the Game by Daryl Fairweather. It's available on Amazon. People should check it out. So you use game theory throughout the book. It's a very interesting concept to apply to everyday problems that everybody struggles with. About getting rent, buying a home. You specifically comment on, I guess, struggles that the everyday person goes through getting a home. For example, the bidding war you've commented on. You write about losing bidding wars and the mental fatigue that comes with that. When does a buyer decide to whether or not to take a pause in looking for a home in bidding, or push through, for example?
Well, I think you have to be really self-aware as a buyer and kind of know the environment that you're in. So during the pandemic, it was very much a seller's market. Homes were getting multiple offers, sometimes dozens of offers, and selling for hundreds of thousands of dollars over asking price. Austin was a great example of this. And I think now a lot of people who jumped into that housing market and got swept up in a herd mentality, kind of following what other people were doing, are starting to regret it, because homes have come down in value. So one way to not overpay for a home is to be aware of when you're just kind of following the crowd and getting swept up in the moment, and you need to take a break and kind of see things from an outside perspective to make sure you don't end up overpaying or making a decision you might regret.
Most people, and I've gone through this myself when, looking for a home, we don't know what the market is. We don't follow stats. We don't have agents' reports. We don't follow Redfin. People should, but, most people don't. So we don't know what the market trends are. So what are some of the questions I should be asking a seller or even my agent to determine whether or not, first of all, we're in a buyer's market or a seller's market?
Well, a good way to know whether you're in a buyer's market or seller's market is the average sale to list ratio. This is whether homes are selling for above their listed price or below their listed price. And you can look this up at a neighborhood level. You can even look it up at the Redfin data center. You can just type in your neighborhood or zip code and see what the average sale to list is. But your agent should have this information as well. And that will tell you whether you're in a buyer's or seller's market. You should also pay attention to the homes that you're making offers on and look at their days on market. How long have they been on the market? If they've been lingering on the market for a long time, that's a good sign that you can come in under the listed price and still get the offer accepted. But if it's only been on the home for a few days and it's already marked as a hot home on Redfin, you're probably going to need to be more competitive and come in at listed price or above listed price in order to win that home.
And similarly for renting, let's say you're in the renter's market, let's say I'm looking for a home and I don't know if I should be bidding for a particular home as a renter or perhaps asking for a discount. Are there rules that I should follow? Should I always just be asking for a discount regardless?
Yeah, I think it's good to know what kind of a market you're in. You can look at the vacancy rate to determine whether it's more of a renter's market or a landlord's market. You can also look at what other units are listed for and whether the unit you're interested in seems to be overpriced or underpriced. But a good negotiating tactic when renting is to ask for discounts like a free parking spot or a free gym membership or first month's included of rent, things like that. Those things are things that landlords tend to be willing to negotiate on, because it means that if they are in an area where there is a rent cap on how much they can increase the rent, they can still increase it the next year without having to sacrifice what that base level of rent is that you're paying in that first year.
I didn't even know first month rent was free was possible. Thank you for giving me that idea. Thank you. All right. Well, it's just a personal anecdote. I was talking to somebody the other day. I live in Vancouver, BC, and prices are coming down for both the home market and the renter's market. But there was a gentleman I was talking to, and he's a landlord, and he had to mark down his rent for the first time, I think, forever. And he's a bit of an older gentleman, so he's not like new to the market. And this is a trend that I personally have never seen in my life, where landlords are actually marking down rents. Have you noticed similar markets in the U.S. where you're based, and what could be contributing to, I guess, a slower rental market as well?
Yes, that's happening in the same places where we're seeing down housing markets, where there has been a lot of multifamily construction, like in Texas and in Florida and these other big pandemic migration destinations, where builders built a lot of condo towers and apartment buildings with 1-bedroom units and 0-bedroom units. And those aren't the kinds of housing that people really desire. So when you overbuild and there's too much supply, you do have to mark down rent. This year, we probably won't see as many rent markdowns as we did last year, but in certain markets we will. So again, it's a good idea not to just sign your lease blindly when it's up for renewal. You should do some research. You should look at what else is available and bring that data to your landlord and show them that, the market rent has come down and that you're going to move if you don't get a better deal.
Yeah. Well, you have entire sections in your book dedicated to buying a home. So best pieces of advice you have. Without spoiling too much of the book, people should check out the book. For those of us who are looking to buy a home, maybe for the first time, or maybe we've been in the market for many years already, and this is not our first home. Any differences between a first-time buyer and an experienced buyer, and best pieces of advice for anybody?
Well, I think it's really easy for a first-time buyer to overlook like some expenses that actually are pretty significant. Like whether you get shopping around for a mortgage rate can be important in terms of lowering your overall cost of buying. Coming in under asking price if the home's been on the market for a while can get you a big discount. And also there are things you can negotiate for during the escrow period, like an inspection contingency. You can ask for a rate buy down from the seller. There's all these little things that you can negotiate for. But my biggest advice is really to just focus on your personal situation. You want to buy a home that you are going to stay in for at least 5 years, because that's when you start seeing the return on investment really come through. the biggest mistake you can make is to buy a home and then have to sell it again in just a year or two, because you're going to have to pay real estate agent fees, excise taxes when you sell, and that can really take a big chunk out of your investment.
Well, what about those people looking to buy maybe a second or third property solely as an investment vehicle, whether it be a condo or maybe a single family home to rent out? What are some of the macroeconomic indicators around that region they should be following and staying vigilant on?
Yeah, I mean, the thing you want to look for is this: do you expect this market's rent to continue to increase? Is it a neighborhood where the labor market is growing, where wages are going up? That's a good indicator that rents are going to increase over time and home values will increase over time. I think that a lot of people, when they buy their first investment property, they think of it as this passive investment, but it does end up being a significant amount of work to deal with the tenant, to deal with maintenance. So just know that you are signing up for a bit of work, but you can earn that back in terms of sweat equity. So it could be definitely worthwhile.
Well, the age-old question as to whether or not I should be buying or renting, assuming I have the cash for the down payment. How would you approach that question? Obviously depends on who's asking, but how would you help a person sort through that thought process?
Well, usually buying is a better investment if you know you're going to be in the home for at least 5 years. There are lots of rent to buy calculators. The New York Times is a good one if you want to get into the actual details of your situation, like how much you're putting down or what interest rate you're getting. But usually 5 years is around the mark when you start to make back your money. And also part of it is lifestyle too. Do you prefer to have somebody take care of all the maintenance, or would you like to do some of that maintenance yourself and you can build sweat equity that way? And also, do you want to know for sure that you are going to be able to stay in your home for as long as you want, versus being at the will of a landlord who can raise your rent or terminate the lease, and then you have to go find another property, and moving can be quite expensive. So I think it really comes down to whether you're ready to settle down and lay down roots or not.
Well, the American dream used to be that you would own a property and a home. Is that still the American dream, especially given how unaffordable housing is for a lot of people, like we discussed earlier? And we have to factor in maintenance costs. There's this new wave of thought that I've heard that perhaps it's better off financially to just rent a home for the rest of your life, even if you could afford to buy a home, given how high these maintenance costs, interest costs are, and how high the entry cost is to purchase a home. You're better off just putting that money in something else to invest in rather than a house. Is that still the American dream, to own a home?
Yeah, it's true that, the stock market in general has better returns than real estate. You're able to diversify better in the stock market than if you're just buying individual homes. So if you are the type of person who is very disciplined about investing and you will put money in the stock market every single month, the same way you would pay your mortgage every month, then perhaps renting is better for you and you can get a higher investment. But I think that home ownership is such a deep psychological desire in America that I think it really is what people want, even if it's not as high of a return as the stock market. I think people really do value this idea of owning something, being able to do whatever they want with the land and the property, and just kind of having that freedom in a sense when you own your own home. And I think you can see that reflected even in policy, the way that we subsidize mortgages at a federal level, and the way that we tend to bail out homeowners when there are natural disasters. I think that as a nation, we really do hold up home ownership, and I don't see that changing anytime soon.
Okay. And what about resale value? You've discussed that in your book. How should somebody think about resale value of their home?
Well, the mistake that a lot of sellers are making right now is they're anchoring to a price that is not the market price anymore. They're looking at what their home would have sold for a few years ago, and that's what they list their price at. Or sometimes they anchor to what they paid for the home, and they don't want to accept anything less than what they paid. And that is really a psychological trap, because it's the buyers who determine what your home will sell for. It's the market. It doesn't matter what you bought your home for, what prices were a few years ago. So I think you need to kind of get rid of that sunk cost fallacy and just look at what is happening in the market right now and decide if that is worthwhile for you to move. And I think something that people tend to overlook when selling their home is the opportunity that they're getting when they move. Like if they're moving for a new job, or if they're moving to have a shorter commute, or to be able to start a family, all of those things are going to reap you rewards into the future. So you shouldn't just look at what you might be missing out on in the past. You should think about everything you can gain moving forward.
Should I just apply the inflation rate to my home over the number of years I've lived in that home if I want to sell it? Is that a starting point?
No, I mean
Okay.
that could be a rule of thumb, but I think
Okay.
you should. I mean, the best way to determine what to sell your home for is to look at what comparable homes have sold for
Okay.
recently, and then also adjust for how has the market changed since those comps sold, because usually there's a bit of a lag in terms of knowing what homes sold for, like maybe a 3-month, 6-month lag. So knowing how the market has changed in the last 6 months can help you understand whether to go a little bit above the comp or a little bit below the comp. But it really is about what homes are selling for right now, not some rule of thumb or what you paid for it.
Finally, your book doesn't talk about solely real estate. You've also examined how people, live life. They go through college, they find a partner, settle down, have kids, eventually buying a home. Have you noticed any shifts in, I guess, behavioral trends in current generations versus past generations, and how they go through life now versus how our parents or grandparents did the same things?
Yes, I mean, younger generations are hitting those milestones later in life, whether it be buying a home or getting married or having kids. It's happening later for them. Part of it is that I think that they want to be more financially well off when they do decide to have a kid, and they feel like owning a home is this financial accomplishment that makes them a real adult that allows them to have a kid. It's really not true. I mean, you can obviously have a kid when you're renting, but in the data, it still is this high correlation between when you buy your first home and when you get married or have your first kid. And people are just getting there later. And part of that does come down to housing affordability, because if it takes a longer time to save up enough money to be able to buy a home and you want that home before you have that kid, then that can delay all those steps. But also people are living longer and people are able to have kids later into life. So yeah, I think it's just a different time frame that people are going about things nowadays.
Okay, great. Well, I'd like to just end on a personal note. I mean, you've had a very successful career, first working private sector for Amazon as well before you transitioned into Redfin, and PhD economics. You did that at Chicago. So tell us about your career and how you went through life, how you decided on hitting these major milestones and inflection points in your life, and the decisions that you had to make to overcome some of these challenges for our younger audiences who may be interested in also in a career in economics.
Yeah, I mean, I'm an economist, so going through all those life milestones, I definitely looked at it through an economic lens, whether that was deciding to go to grad school or not. I mean, part of the decision to go to grad school was that I loved economics, but it was also during the Great Recession when it was very difficult to find gainful employment. So weighing the pros and cons, the different options was definitely part of that. And then when I got to grad school, I decided I didn't want to stick in academia and continue on to be a professor. That was my original goal, but I discovered that being a professor is not everything it's cracked up to be, and it's a pretty hard path. So I went into the private sector, and I initially moved to San Diego, but then I ended up having to sell my home that I bought in San Diego after just 1 year. I made that mistake I talked about because I found a better job in Seattle working for Amazon. So again, I looked at it through this behavioral economics lens of not getting caught up in the sunk cost fallacy of, I made this mistake, but really looking at what the opportunities were for me moving forward. And yeah, this is how I try to make all my decisions, is look at the option value of taking a risk versus staying the same. We all tend to have a bias for the status quo and to not make big changes in our lives, but that can bias us away from really making big improvements in terms of our earnings or our life satisfaction. So I try to use economics to help me be more brave in those decisions and just approach it more rationally.
I mean, the real estate sector is probably one of the most complex asset classes in the world to study. How have your research processes regarding real estate changed over time? In other words, what you're doing now to research real estate trends and identify trends, what have you learned recently that maybe you didn't know before at the start of your career about real estate?
Well, there's so many data sources in real estate. I think one of the great benefits of studying real estate is that we have really rich data, public data from county records and MLS data from all the different MLSs around the country. And it's really just a matter of sifting through all of that data. And recently with AI and, tools like Claude Code, it's becoming easier to really dive deep into that research and find new insights. That's something that I'm excited about now, is just the speed at which we can do research nowadays.
Okay, great. Well, I appreciate your time, Daryl, and thank you for coming on the show. So where can we follow your work?
I'm on all the social media. I'm on Twitter, Instagram, TikTok as @Fairweather PhD. And you can also find me on YouTube and LinkedIn. I have a Substack, but you can just search for my name, Daryl Fairweather, and I'm the only one as far as I know. So you can find all my social media.
Okay, we'll put the links down below, and don't forget to check out Daryl's book. Link on Amazon. I'll put the link down there. Thanks again for coming on the show, Daryl. Appreciate it.
Thank you for having me.
Thanks for watching. Don't forget to like, subscribe, and don't forget to follow Daryl in the links down below. And finally, don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. Remember, new traders get $10 deposited to your account when you trade $10. Use my code LIN, description down below, or scan the QR code here.